Hi, Dr. Dolly. My wife and I, we're both about 40 years old. We're both physicians, and our current net worth is about $4 million. We max out our 401k plans. We do backdoor Roth IRAs for 6,000 each. We have two kids. We put 600 per month per kid towards a 529, 800 per month per kid towards a brokerage account for each of them, currently in Wealthfront. And then on top of this, we save about anywhere between $50,000 and $90,000 a year. I've been putting this excess savings towards brokerage account mostly, and occasionally I will use some of it to pay off my mortgage, which sits at 3.5% with a balance of $900,000. The mortgage is my only debt right now. My question for you is, should I be taking the excess savings that I have each year and paying off the mortgage and ignoring brokerage accounts at the time for the time being, since I have the 401k and backdoor Roth? My thought was that if the stock market returns 6%, even after long-term capital gains, maybe I come out ahead by putting it towards the brokerage account as opposed to my mortgage. Any insight you can offer would be great. Thanks again for all that you do. It's extremely helpful.
You're killing it, David. You're doing great. I'm sure some listeners are like, why is this guy calling in? He's just humble bragging. But, you got to have those details. And the wonderful thing about the White Coat Investor community is, yes, we spend all day talking about first world problems, but at least it's someplace you can come and talk about your first world problems. This is actually the most common question I get. It's super common because everybody struggles with this. But I think you said it very well, right? You said, well, shoot, I got this mortgage at 3.5%. It's a big mortgage, $900,000. So I could spend a lot of time and a lot of money, put money towards that. Or I could make 6% or even more in the stock market or in real estate or in something else. Well, I think you said it exactly right. Maybe you earn more in the stock market or real estate or something else. Because here's the deal. That 3.5% is a guaranteed return. Anytime you pay off debt, it's a guaranteed return. Now, if that's deductible interest to you or whatever, maybe the rate's slightly lower than that. Maybe it's 2.7% or something like that, and that's your guaranteed return. But whatever it is, that's a guaranteed return. And if you look at your other guaranteed return investments out there, like a treasury bond or something like that, it's not paying 3.5%. So that's a very attractive, safe investment for you. So the question comes down, do you need more safe investments or do you need more risky investments? So let's step back and just talk about this dilemma that everybody has, at least all those who still have any debt at all, and just give you some general guidelines on it. Probably the best advice I can give you with regards to the pay off debt versus invest question is to avoid the extremes. With this question, 95% of the time, there is no right answer. But 5% of the time, there is. So don't botch it that 5% of the time. For example, if you're giving up an employer match in order to pay off debt, you're making a mistake. You're leaving part of your salary on the table. Likewise, if you're carrying around 30% credit card debt in hopes that your investments are going to outperform it, you're making a mistake. But for just about everything else in between, I can come up with a situation where it makes sense to invest, but I could also come up with a situation where it makes sense to pay off the debt, no matter what kind of debt that might be. So these are both good things. It's good to pay off debt. That is a good thing to do. It builds your net worth. It is good to invest. That also builds your net worth. So it's not like one of them's wrong, one of them's right. They're both right. At its worst, one of them's a little more right than the other. And if you can't tell which one is better for you, it probably doesn't matter much. So don't worry about it. You could even just split the difference between the two, but don't let it paralyze you from doing either, right? Because what happens to a lot of people is they don't invest, they don't pay down debt, they just leave the money sitting in their checking account. That's the wrong move. Do one or the other, but make a decision. This decision is not going to be the one that decides whether you're going to be financially successful or not. The most important decision in this regard is what percentage of your income is going toward building wealth, whether that's investing or whether that's paying down debt. That's far more important than exactly how much of it goes to which of those. But let's talk about 7 principles that help you determine whether you should pay off debt or invest. The first one's your attitude about debt. If you hate debt, then you're going to lean more toward paying off debt. Likewise, if you have a low risk tolerance, you're going to lean more toward paying off debt because that's a guaranteed return. If you have a very high risk tolerance, you may want to invest more aggressively and even doing it on margin, which is essentially what you're doing anytime you have debt. The third one is your available investment accounts. Okay. This had a major effect on how we made our choices about paying off debt versus investing. We never paid off debt unless we had already maxed out all of our tax-protected and asset-protected accounts, like 401ks, Roth IRAs, et cetera. And so it wasn't until we started looking at a taxable account before we actually started putting chunks down on our mortgage. So that should have a pretty significant effect because investments in those accounts are way better than investments outside of them. The fourth one is your anticipated investment, right? What are you going to do with the money you don't put in there? If you're going to put it into bonds instead of paying off a 3.5% mortgage, that's dumb, right? If you're going to put it into, this great small business idea you have that might pay off incredibly well, millions of dollars over the years, well, then it probably makes sense to do that instead of carrying around, instead of paying off a 3.5% debt. The interest rate has to play into it, right? You're smarter to pay off a 12% loan than you are a 4% or a 2% loan, especially right now with inflation running around 5%. I mean, even if you have a 3% loan, technically right now, they're paying you to have the money, even though you got to pay interest, right? The loan becomes worth less and less every year. The sixth factor is your level of wealth, right? The wealthier you are, the less you have to worry about this stuff. The more you don't have to optimize your finances to reach your financial goals once you've already met them. In fact, William Bernstein likes to say, when you win the game, stop playing. And that's kind of the way we felt when we paid off our mortgage. We just said, you know what? We don't have to do this anymore in order to reach our goals. So we just sent in a few checks and paid off our mortgage. But if you have a 4-figure portfolio and you're decades away from financial independence, maybe your priority shouldn't be paying off a 3 or 4% mortgage. All right. Final factor as far as paying off debt versus investing is asset protection and estate planning considerations. Depending on your state laws, sometimes it makes sense to pay down a mortgage. If you're in Florida or Texas or a similar state with a unlimited homestead exemption, that money's all tax protected. I mean, not tax protected, it's asset protected. Whereas if you invest in a brokerage account, that's totally exposed to your creditors. And then, of course, there can be some estate planning considerations. Imagine you're old, you've got some taxable investments with low basis. Do you sell those investments to live off of, or do you borrow against them? One of them has a tax bill, the other one has an interest bill, and you have to weigh those two factors against each other. And so in that case, it might be better to leave the money invested and take out additional debt. It's kind of a tax play that way. So if you need some specific instructions, let me give you some specific instructions. But realize that these are not set in stone. Reasonable people might disagree slightly about them. But if you follow this, you're going to do fine. Step 1, make sure you get any employer match. Step 2, pay off high interest debt. If it's 8% or higher, that is a fantastic guaranteed return. Step 3, max out your available retirement accounts, right? If you're in your peak earnings years, we're talking about tax deferred accounts. If in your non-peak earnings years, we're talking about tax-free or Roth accounts. You might even consider non-retirement tax protected accounts if they're aligned with your goals, like an HSA, a 529, a UTMA, that sort of stuff. Okay, step 4, investing in assets with high expected returns, right? Obviously, it makes sense to do that. If you're not going to get a high expected return, paying off debt starts looking a lot better. Next, I'd pay off moderate interest rate debt, 4 to 7% kind of debt. Next, I would invest in assets with moderate expected returns. And then I would pay off low interest rate debt. And finally, invest in assets with low expected returns. Hopefully, that's helpful to you to have a list that will allow you to know what to do in this situation. Just realize you shouldn't stress a lot about it. Just do something. Concentrate on how much of your income is going toward wealth building, and don't stress too much about how much of it goes toward debt and how much of it goes toward investing. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.